India is quietly running the biggest financial experiment on Earth. Foreign investors pulled out $19 billion this year, and the market didn't crash. Gold hit record highs, and 26 crore ordinary Indians kept investing anyway, every single month, without flinching. These are the 10 trends rewriting India's money story in 2026, and why they're happening. Number 10. The tax code got dramatically simpler. In September 2025, the GST framework was overhauled. The old 4 slabs were replaced with 2 base rates, 5% and 18%, plus a 40% rate for luxury and sin goods. Why it matters? Fewer slabs means fewer disputes, less paperwork, and lower compliance costs for small businesses. India spent years being mocked for tax complexity. This was the correction. Number 9. Gold went absolutely vertical. As of July 2026, 24-karat gold in India is trading around 14,200 rupees per gram, record territory. But here's the twist nobody talks about. Indians aren't just buying jewelry anymore. In January 2026, gold purchases through UPI hit their highest level on record, nearly 90% higher month on month, and more than 4 times higher than the year before. Digital gold, bought in 100-rupee chunks, from a phone. The most traditional Indian asset just got the most modern delivery system. And it's not just households. The RBI now holds around 880 tons of gold, about 17% of its foreign exchange reserves, up from 12% a year earlier. The central bank is hedging too. Number 8. The cost of money settled down. As of June 2026, the RBI held the repo rate at 5.25% with a neutral stance. Why this is a trend and not just a number? A stable rate means predictable EMIs for home loans, steadier FD returns, and businesses that can actually plan. After years of whipsawing, boring is the point. Number 7. UPI became invisible infrastructure. There's still no merchant discount rate on person-to-merchant UPI payments, and UPI transactions remain outside the GST net entirely. Pay 1,000 rupees, the receiver gets 1,000 rupees. That's why a tea stall in a village accepts digital payments while card machines never made it there. Zero cost to the merchant was the entire unlock. Number 6. The fixed deposit is losing its grip on the Indian saver. The credit-to-deposit ratio has been near its lows, partly because savers now prefer equities and mutual funds over FDs. This is the single biggest behavioral shift in Indian personal finance. For generations, the script was FD, PPF, LIC, gold. That script is being rewritten in real time. Number 5. AI arrived in wealth management. Analysts tracking Indian fintech expect a wave of AI wealth advisors and digital advisory platforms targeting DIY investors, bringing the kind of guidance once reserved for high-net-worth clients to ordinary savers at low cost. The logic is simple. India created tens of millions of new investors very fast, and there aren't nearly enough human advisors to guide them. Software fills the gap. Number 4. Indians started investing outside India. Global diversification, gift city, and cross-border rails are now core fintech themes, meaning Indian money is increasingly looking abroad for a slice of the portfolio. Why now? Because a generation that grew up on global apps, global brands, and global content doesn't see any reason its portfolio should stop at the border. Number 3, and this is where it gets dramatic. Foreign institutional investors pulled roughly $19 billion out of Indian equities in 2026. In previous decades, That alone would have gutted the market. It didn't. In March 2026, when the Nifty corrected 11%, domestic institutional investors injected 1.36 lakh crore rupees into the system. The money that left was replaced by money from inside the country. Number 2, the sheer scale of retail participation. India now has a record 26 crore registered investor accounts, with total SIP assets under management at an all-time high of 16.85 lakh crore rupees. And it's no longer a big city story. Participation has expanded well beyond metro cities, supported by digital onboarding and rising financial awareness. Small towns are now a serious source of market capital. Which brings us to number 1, the single most important financial trend in India right now. Ordinary Indians stopped panicking. In April 2026, SIP contributions reached 31,115 crore rupees, even as global markets wobbled and institutions sold heavily. Lump sum investments dropped sharply, but the systematic monthly money held firm. Read that again. Discretionary money got scared and sat out. Automatic monthly money didn't move at all. That's the whole story of modern Indian finance in one data point. And here's the mechanism behind it. Automation. Once a SIP is set up, doing nothing is the default. The system removed the moment where fear gets to make a decision. Analysts describe this shift as structural rather than cyclical, driven by the financialization of savings, a young population entering its wealth-building years, and digital platforms making investing genuinely easy. But, and this matters, none of this makes the market safe. One documented pattern is investors chasing last year's returns, piling into mid- and small-cap funds after big rallies and buying near the top of a cycle. Discipline in contributing is not the same as skill in choosing. India has solved the first problem beautifully. The second one is still wide open. So that's the picture. Simpler taxes, record gold, stable rates, free payment rails, dying FDs, AI advisors, global portfolios, foreign money leaving, domestic money staying, and 26 crore people who just kept going. India didn't get rich in 2026. It got habitual. And habits compound harder than any single good year ever could. Which of these 10 surprised you most? Comment the number. And if you've got a SIP running right now, comment steady. Let's see how many of you there are. Subscribe for more of how money actually works in India.